Hi everyone! In my last video, I talked about how to use the bond market as a fundamental indication of the future outlook of the stock market and what stock sectors could outperform the broad market in the near future. And today, I want to share with you from a technical point of view 2 indices that I keep my eye on for spotting the potential turning point of the broader market. So stay with me if you're interested. Welcome to the Wild Finance. My name is Yusing, and on this channel, I share with you my investing tips and strategies to become financially free. So subscribe to this channel if you are interested in that. Now, the first index we should definitely keep an eye on is, of course, the US dollar index. The reason is simple, because the US dollar is the world's reserve currency. If the dollar goes down, most assets would go up, because people are incentivized to sell their dollars and buy assets. And if the dollar rises, then the most assets fell, because people are incentivized to sell their assets and buy back dollars. Now, if we look at the dollar index chart and overlay with the S&P 500 index chart, we can see that throughout the most period, when dollar trends down, the S&P 500 trends up, especially during the market crashes in 2000 and 2008. Both times when the dollar topped within the next 3 to 6 month time, the stock market bottomed out and started major rallies afterwards. And in the recent COVID crash, when the dollar topped, it marked almost exactly the bottom of the stock market. And after that, the dollar has only been going down while the stock market is creating an all-time high after another all-time high. Well, we all know the reason of this rally is mostly due to the excess amount of money printing the Fed started during the depths of the COVID crash. The Fed is artificially trying to keep the dollar price down so that the US economy doesn't implode. But no one knows how long this will last. In fact, if we look at the dollar index chart from a pure technical point of view, the dollar is sitting at a strong support level, which it has bounced twice this year, one at the beginning of January and another at the end of May. And previously, it also had bounced several times during January 2018 to April 2018. And we all know later in 2018, throughout October to December, we had the stock market deep correction of more than 20%. Will this happen again later this year? Well, if the dollar index keeps going up from here, then I would say we have a bigger probability of a deep market correction maybe towards the end of this year or the beginning of next year. But if the dollar index turns around and starts to trend downwards, then we probably will not have any major corrections and instead a big melt up in the stock market. Which direction do you think the dollar is going? Let me know by leaving a comment down below. Now, the second index we should keep an eye on is the volatility index, the VIX, also known as the fear index or the smart money index. Because when the volatility is high, it usually indicates lots of fear in the market. And when the volatility is low, it indicates the market is greedy. And as Warren Buffett says, be fearful when everyone is greedy and be greedy when everyone is fearful. It's also a good way to check the sentiment in the market and prepare for the potential swings. Most hedge funds managers are using this index to hedge their positions against the potential market short-term volatilities. Here's how you read the volatility index chart. The lower the number, the lower the volatility. And the higher the number, the higher the volatility. And usually in a market uptrend, the volatility is relatively low. And the increased volatility usually means a sharp drop in the stock market. You see those volatility spikes on the chart? They all coincide with the market correction or crash. If we overlay the S&P 500 chart on it, you will see each spike corresponds to a major correction or a crash. And here is how I'm using this chart. So in a stock market uptrend, when the volatility bounces from either the yellow dashed line or the white line, it usually is signaling a short-term pullback could be on the horizon. If you want to hedge your position, you can either sell the security directly to the market to make your unrealized gains to realize profits, or you can sell covered call options to collect a premium to lower your purchasing price of the underlying security. While I don't recommend selling naked calls, it is very risky because you are using leverage through borrowing money to do so. Now, let me know if you guys are interested in options. Leave a comment down below. Now, when the volatility increases and hits the pinky line, it usually is a nice pullback on the uptrend where you can add to your position through buying the dip. And if the volatility shoots straight through the pinky line, then we probably experienced a major correction or a crash. And when volatility starts to go down from the spikes, then it could signal a market bottom where we can aggressively buy back the shares. And at the recording of today, on 8th of July, the S&P 500 has dropped 1.4% up to now. So that's why you see the VIX has bounced from a relatively low value. It got a little spike here. So now we need to monitor the situation closely because if the VIX keeps going up, then we probably will see a bigger pullback in the very near future. But if the VIX start to going down again, then the pullback is probably very short-lived. And during the editing of this video, I thought I'd mention this 20-year Treasury bond here because ever since my last video where I talked about bond and stock market correlation, the bond has gone straight up. It has not only established itself above the support line here, it also breaks through this red resistance line. What does this mean is most investors are now anticipating a lower inflation in the near future. So this might hurt the stock market a bit. If you want to know why, then I would recommend you to go watch my previous video where I talked about the bond and stock market inverse correlation. So in short, if the bond price keeps going up, then this indicates that the stock market is bubbling a correction in the near future. So if we combine these three indications, it seems like they all give some kind of warning sign a stock market correction is coming. But the question is, we don't know the magnitude of the correction or the pullback will be. But in any ways, I think we should closely monitor the situation for now. If you like this content and want more of it, then please let me know by making the like button blue because the gray color is just so depressing and sad. Well, that's it for today, and I will see you guys in my next video. Bye!